You need to know this morning, the major market averages are once again in sell-off mode after a brutal day in Asia. Europe also in the red. Here's what it looks like for the U.S. stock market. We are looking at a sharply lower opening this morning, down better than 400 points. As you can see, the Nasdaq down 156 points this morning, 3.75%. This global stock sell-off is accelerating on worries about the health of China's economy and a slowdown there. I want to bring in Mark Luschini. He is Janney, Chief Investment Strategist. Mark, good to see you. On a day that we know we are going to fall out of bed again after 2 days of sharp sell-offs last week, what do you want to do as an investor? What are you telling clients this morning, Mark?
Maria, don't panic. This has been a process that's been long in coming. We've known for quite some time that the market was ripe for a pullback of some order. And in fact, what we're starting to see, of course, is I think some derating in equity prices to reflect some of the things that we've been watching for some time, which doesn't just include, obviously, the slowdown in China and the blowback to other emerging market countries, but as well the fact that market internals have been melting now for almost a year. And so we expected some reconciliation at some point that the indices would have to reflect what's going on in the broader market. But ultimately, we think this too shall pass, even if it is ultimately from lower levels than where we are today, and stocks will resume their advance.
So how sizable a correction from top to bottom would you expect? We are already down on the Dow Jones Industrial Average 10%, meaning we are officially in a correction. Do you think there's another 10% of selling? Do you think there's a little more? When would you expect that we see opportunities in terms of buying on that dip that you're referring to?
Yeah, Maria, we're trying to handicap, obviously, the catalysts that are helping to conspire to drop equity prices to the point where we could make some determination of that. At the end of the day, I would expect another 3 to 7%. I don't know about a full 10% more, but I still think that we have further to go. But along the way, we'd probably be advocating legging into this market at some point because we're not ultimately going to be able to time the bottom perfectly. And yet at the same time, we would say caution continued is warranted given the fact that it looks like this is sort of feeding on itself at the moment. Investors seem to be wanting to sell first and ask questions later.
Hey, Mark, long-term interest rates are coming down now. The dollar is getting stronger. As an investor, how do you play those two trends? How do you take advantage of the drop in long-term interest rates and the possibility that the dollar is going to keep strengthening? Where does money go as a result of that?
Well, I think money goes to the U.S. if the dollar is going to continue to strengthen. I mean, obviously, we had been for some time advocates of international equities, particularly since valuations in Europe and Japan were very cheap, but on a hedged basis. So we would still continue to promote looking at overseas international equity investments for investment, particularly in developed market countries, but on a hedged basis to offset that dollar strengthening. As it relates to the lowering of interest rates, obviously, cost of capital will remain cheap. And as a consequence, you're going to continue to see, I think, heightened M&A activity. But at the end of the day, what it means for bond investors is that they're going to continue to get squeezed out of fixed income investments as a source of cash flow. And therefore, I think we'll have to look to dividend-paying stocks, a strategy dividend-paying stocks that's really been out of favor now for 12 to 18 months.
Anthony.
Well, where do you see the economy in the middle of 2016, if you can look out that far? Stronger?
Anthony, on balance, probably not necessarily much stronger, but certainly not weaker. We've had this sort of no boom, no bust philosophy as it relates to the U.S. economy, whereby we continue to see enough inertia in the economy through the kind of job growth we've had, consumer confidence, the gas tax cut, all these things collectively helping to spur positive economic activity, albeit sub-trend. I don't think that necessarily gets derailed unless, obviously, circumstances overseas continue to deteriorate to the point where we are no longer decoupled from what's going on a global basis. I don't expect that to happen, and therefore, while I expect we'll continue to see modest economic growth, it'll be positive into 2016.
Mark, it's Dagen McDowell. How would you rate the individual panic that you maybe heard after the market closed on Friday or over the weekend in terms of the types of calls that you were getting?
Yeah, Dagen, important because the chirping's starting to get a little bit louder. You know, it's interesting as you get closer to turning points where you start to, from a contrarian standpoint, tune your ear to what you might start to hear from investors relative to the kind of pain they're beginning to feel as a consequence of the decline in the equity market. And clearly the noise has gotten a little bit louder. Not quite to the point of panic, not quite to the point where we're actually seeing clients repaper their investment policy statements to say, get me out of stocks. But at the the same time, you're getting a little more anxiety and a little bit of a kind of a punch in the stomach kind of feel relative to what we're hearing from investors in terms of how far is this going to go, and should I be contemplating whether or not to do anything relative to my equity position at this juncture. And obviously, our advice is stay the course for the time being, but at the same time, we're looking for signs and around the corners as much as anybody as to whether this could get significantly worse or not, which is not our base case.
Mark, good to have you on the program today. We so appreciate your insights. Thank you.
Thanks, Maria.
We'll see you soon, Mark. Thank you. Mark Luschini there joining us from Janney.